Welcome to episode 1 of our educational series on real estate taxation basics. Be sure to watch our series on 1031 exchanges and passive real estate investing basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
In layman's terms, a capital gain is simply the profit realized when an asset is sold, typically because the asset has appreciated in value. When you buy a stock for $500 and sell it for $1,000, the stock's value appreciated while you owned it. The difference of $500 is your capital gain, and regardless of whether you were smart or lucky, the government is ready to take a considerable piece of your profit.
The concept of the federal government taxing capital gains took shape over a century ago. Back then, capital gains were not distinguished from other income for tax purposes. Indeed, that is still the case in some states. Over time, capital gains became a separate category, with varying tax rates and exceptions depending on the hold period, the asset type, and so on. Insurance, annuities, retirement accounts, traded securities, mineral rights, and real estate all have different tax treatments.
But let's focus on real estate. Determining your capital gain on a real estate sale starts with your cost basis. There are 3 general factors that affect your cost basis. The first is the amount of your initial investment. Then we add any additional capital expenditures, like a new roof or a pool. Then we subtract any deductions you've claimed for depreciation. We'll discuss depreciation in greater detail in episode 2. When you sell your property, the amount of taxable capital gain you recognize is the difference between your net sales proceeds and your cost basis. Note that you don't get to subtract the balance of your loan when you calculate your net sales proceeds, but you do deduct your transaction expenses, like commissions.
Let's use a simple example. Suppose 10 years ago you bought a rental property for $500,000. Let's also suppose you added another $50,000 of improvements. And finally, let's assume you have deducted a total of $100,000 in depreciation over the last 10 years. Your cost basis would be $450,000. Okay, now suppose you sold the property for $1 million using a discount broker. Your commissions and other costs are $50,000, resulting in net sales proceeds of $950,000. To calculate your taxable gain, we subtract your cost basis from your net proceeds for a final amount of $500,000.
The next question is, how will your recognized gain of $500,000 be taxed? Well, there are 4 different types of tax in this situation.
First, the IRS is going to tax the amount of your gain that was attributable to prior depreciation deductions. In this case, $100,000 will be considered depreciation recapture under a special tax schedule.
Second, the IRS is going to tax the other $400,000 as long-term capital gains.
Third, the entire gain will be subject to a more recent federal tax known as the net investment income tax.
And finally, in most states, you'll be subject to an additional state income or capital gains tax.
If you had a large outstanding loan on the property, you could end up with a tax bill that is higher than the amount of net cash you received from the sale. It's no wonder that so many people choose to conduct a 1031 exchange when selling a rental property. That's why we have over a dozen videos dedicated to tax-deferred exchanges.
Thanks for watching. Please be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.